Imagine growing your revenue to like $2.3 billion,
Yeah.
just completely shattering Wall Street's expectations, and yet the people who actually analyze your stock for a living are telling everyone to stay away.
I mean, it is totally bizarre. It's a huge
All
contradiction.
right. That is the wild reality of Hims and Hers Health today. Today is April 20th, 2026, and we are looking at a chart that is just, well, it's defying gravity.
Oh, absolutely.
The ticker is HIMS. It just closed at $31.01. That is a 7.6% surge today alone.
Which is massive for a single day.
Exactly, and it caps off this crazy high momentum recovery phase where the stock has rocketed, I think, like 48 to 50% in just a single week.
Yeah, bouncing really aggressively off those late February lows.
Which brings us to the ultimate question for this deep dive. Is this a massive, undeniable, strong buy breakout? Or, are we staring down the barrel of a classic, really dangerous value trap?
It is basically the absolute definition of a battleground stock right now. You've got this raw price momentum clashing directly with underlying structural risks. And our mission today is to cut through all that noise for you.
Right, we're going to dissect the company's financial foundation, look at the tape, the order flow driving this massive surge.
And we really need to unpack why the Wall Street consensus is just completely disconnected from the current price action.
But just to establish the ground rules up front before we get into it, we are analyzing data, trends, and market psychology here.
Right. This is just a natural discussion. There is absolutely no financial advice being given here.
Exactly. And before we break down that fundamental disconnect, a quick request for you listening. Hit the like button, subscribe to our YouTube channel, and it is compulsory, guys. You have to leave your feedback in the comments by the end of this deep dive.
Yeah, we want to know what you think.
We are laying out the bull and bear cases, and I want to know, are you buying this surge or are you staying far away?
So, to figure out if a 50% weekly surge is actually justified, you can't just look at the stock price.
Right, you have to look under the hood.
Exactly. You have to look at the actual financial engine. And on paper, I mean, those numbers paint a picture of a company scaling flawlessly.
They really do. Full year 2025 revenue hit an astonishing $2.35 billion. That is up 59% year over year.
Which is huge growth.
Right. In Q4 alone, pulled in $617.8 million, which is a 28% jump. Net income was really solid, too, sitting at $128.4 million for the year.
Yeah, and $20.6 million just in Q4 alone.
Exactly, with annual adjusted EBITDA at $318 million.
And the balance sheet provides a pretty sizable war chest to support those numbers, too. I mean, as of December 2025, they have total assets of $2.15 billion.
Wow.
Yeah, and that easily covers their $1.61 billion in total liabilities. So that leaves them with $541 million in total equity.
Okay, let's unpack this, though, because when a company is growing top-line revenue by nearly 60% and they have that healthy equity cushion, the initial market reaction is almost always euphoric.
Oh, sure. Everyone loves top-line growth.
But hypergrowth usually hides a mess in the margins. It's like a leaky bucket.
Right.
Whenever I see a company bringing in $2.3 billion, my first question is, well, how much did it cost them to actually make that money?
And that is exactly where the narrative shifts. Because revenue is skyrocketing, sure, but what's fascinating here is the gross margins dropped from 79% in 2024 down to 74% for 2025.
That's a noticeable drop.
It is. And by the fourth quarter, it squeezed even further to 72%.
Wow, okay.
That margin compression is really the fundamental friction at the heart of this stock right now. A drop from 79 to 72 in a single year is pretty severe for a digital health company.
Why is that happening, though?
Well, to understand it, you have to look at the mechanics of customer acquisition in the telehealth space. Hims relies really heavily on digital advertising to bring in new patients.
Right, like Instagram ads, Google search.
Exactly. They are bidding on search terms like, hair loss treatment or weight loss medication on Google and Meta. The problem is, the digital health market has become incredibly saturated over the last 2 years.
Oh, I see. So every competitor is bidding on those exact same search terms.
Yep. Which inflates the cost per click. They literally have to spend significantly more marketing dollars today just to get the same single patient to sign up that they got for way cheaper a year ago.
So it implies rising customer acquisition costs. Or maybe they're facing such severe pricing pressure from competitors that they have to discount their actual subscriptions just to maintain that 59% revenue growth.
Precisely. You're essentially paying for top-line growth by sacrificing your bottom-line efficiency. And this dynamic shows up glaringly in their free cash flow.
Wait, didn't they have positive free cash flow for the year?
They did. For the full year of 2025, free cash flow was positive $57.4 million.
Right, which sounds great.
But in Q4, it flipped to negative $2.6 million.
Hold on, really? So they actually bled cash in the final quarter?
Yes, despite posting record revenues of $617 million.
That is wild. And that fundamental tension really explains the absolute whiplash we've seen on the chart over the last year.
Absolutely.
This underlying business is just caught in a tug-of-war between hypergrowth and shrinking efficiency, which is why the stock has violently swung from a crushing low of $13.74 to a euphoric high of $70.43 over the last 52 weeks.
It is pure financial volatility.
But, you can't talk about a stock price recovering 50% in a single week without asking who's actually buying it right now.
Right. If Q4 was a margin squeeze that ended with negative free cash flow, why on earth is the stock suddenly exploding this week in April?
Well, if you just look at the tape, this stock is a rocket. The technical indicators are flashing a massive strong buy.
Yeah, the charts are looking very aggressive.
We are seeing HIMSS trading well above its 50-day simple moving average, which sits at $20.08.
Though it's worth noting, it is still tracked below its declining 200-day moving average.
Right, which is at $38.29. And that 200-day line often acts as a major psychological ceiling for algorithmic traders. But the immediate momentum is just fiercely bullish.
Definitely.
MACD is sitting at 2.10. And for those listening who might not track technicals daily, the MACD looks at the difference between a 12-day and 26-day moving average.
Right, it's a momentum indicator.
Exactly. So a positive number like 2.0 means the short-term momentum is aggressively overtaking the long-term trend. It is accelerating upward.
But if we connect this to the bigger picture, the speed of that acceleration is what catches the market's attention, but it also creates immediate technical vulnerabilities.
Which brings up the 14-day relative strength index.
Yeah.
The RSI.
Right. Where's the RSI at right now?
It is currently sitting at 71.46.
Oh.
Yeah. That's like redlining a car engine, right?
Okay.
An RSI over 70 means we are officially in overbought territory. It's like a rubber band that has been stretched so far and so fast that the potential energy is just maxed out.
Right. The stock usually has to snap back to relieve that tension before it can be stretched again.
So the big question for traders is, can this momentum realistically break through the immediate resistance at $33, let alone that major technical ceiling sitting at $41?
It's a tough barrier.
Or is the rubber band going to snap, sending us crashing right back down to those strong support levels at $25.50 or $21?
Well, to determine if the rubber band snaps or breaks through, you really have to look at the volume.
And the volume on this breakout is staggering.
It really is. We are talking about 69.3 million shares traded recently. That is more than double the average daily volume.
Right, and you don't get 69 million shares changing hands simply because, retail traders like to chart setup on Twitter.
No, absolutely not. That requires institutional force. Extreme volume like this usually points to a severe imbalance in the market, most likely a short squeeze.
Okay, explain that a bit more.
Well, given the margin compression we discussed and that violent drop from $70 down to $13 earlier in the year, the stock accumulated a very heavy short interest. A lot of people were betting against it.
Makes sense.
So when the price started bouncing aggressively off those February lows, short sellers were likely forced to buy back shares to cover their losing positions.
Wait, really? Are we assuming this is a massive short squeeze just based on the volume? Couldn't this just be retail traders piling into the ongoing hype around GLP-1 weight loss drugs?
Retail momentum is certainly a factor, but retail capital is typically too fragmented to sustain a 50% weekly move on double the average volume without some sort of algorithmic or institutional participation.
That's a good point.
When you see 69 million shares move in a compressed time frame, it is almost always forced buying. Squeezing short sellers forces them to buy at higher and higher prices, which creates this self-fulfilling loop of upward price action.
Okay, so if it's not a squeeze, what's the alternative?
The alternative explanation is massive institutional reentry. Smart money might be trying to aggressively front-run the upcoming FDA regulatory catalyst.
Building their positions before the news officially drops this summer.
Exactly.
But here is the huge disconnect. If institutions are allegedly buying up 69 million shares and the technicals are screaming strong buy, why are Wall Street analysts completely unenthusiastic?
Yeah, they are not on board at all.
A second you step out of the trading pit and into the equity research departments, that momentum just hits a brick wall. The analyst consensus is a glaring hold.
Just a hold.
Yeah. Out of the 13 analysts tracked, you only have 4 buys. You have 10 holds and 0 sells.
Interesting.
But here's the part that really makes you scratch your head. The average 12-month price target is sitting between 24.31 and 26.98.
And the stock is trading at 31 today.
Exactly.
Yeah.
So what does this all mean? The pros literally think it belongs at $25.
Basically, yes. Wall Street views the current price action as severely short-term overextended. It's totally disconnected from the fundamental baseline.
Right.
Analysts build their price targets based on projected cash flows, not RSI or MACD crossovers. The stock price has simply outrun the fundamental reality that analysts use in their valuation models.
So they're just waiting for the numbers to catch up.
Take BofA Securities as a prime example. Just a few days ago, on April 16th, 2026, they raised their price target from $21 to $25.
Okay, so they did revise the target upward.
They did, but they strictly maintained a neutral rating.
Why raise the target but stay neutral?
Because they are adjusting to the baseline improvement in top-line revenue, but they are explicitly refusing to chase this breakout. They are signaling that the risk-reward ratio at $31 is just poor.
Oh, I see.
Analysts are essentially paralyzed right now. They are sitting on their hands waiting for regulatory clarity regarding the GLP-1 compounding rules. Until the FDA makes a definitive move, Wall Street is refusing to model in any long-term exponential growth for that specific segment.
So the analysts are playing it very safe. But what about the people actually running the company? The executives have a front row seat to those cash flows and those regulatory meetings.
Insider activity provides a really interesting counter-narrative to Wall Street's caution, actually. Executives like COO Mike Chi and CFO Oyemi Okupe established 10b5-1 trading plans back in late 2024.
And for those who don't know, those are pre-scheduled automated stock sales, right?
Exactly. Executives use them to take profits without running afoul of insider trading rules. But what is critical to observe here is the absence of panic.
No massive sell-offs.
Right. Despite this massive 50% weekly surge in April, we haven't seen any reports of huge off-plan liquidations. Insiders aren't rushing to sell the rip and exit their positions.
They seem content to let their pre-established plans run.
Which suggests they don't necessarily believe this surge is just a fleeting anomaly.
Okay, so this brings us to the core debate for you listening. We have a chart screaming buy, technicals stretched to the absolute limit, Wall Street analysts screaming wait, and a stock price just hovering in the middle.
It's a huge conflict.
Is Hims truly an undervalued growth play just hitting its stride? Or is this a lethal value trap waiting to crush retail traders?
Well, the foundation of the value trap argument really lies in the valuation multiplier. Here's where it gets really interesting. Hims is currently trading at a trailing price to earnings, or PE, ratio of 60.5x.
Let's unpack that, because a 60x PE is incredibly steep.
Very steep.
A PE of 60 means investors are willing to pay $60 today for every $1 of current profit the company generates. You only pay that kind of extreme premium if you are absolutely certain that $1 of profit is going to rapidly multiply into $10 or $20 in the near future.
Right.
But as we already established, their gross margins just dropped from 79% to 72%. It is getting harder and more expensive for them to acquire customers.
Yeah, that margin erosion is a huge red flag.
Paying a 60x premium for a company with shrinking efficiency feels like building a house on a fault line.
And that fault line is exactly why retail traders often get trapped in these setups. This raises an important question about market psychology. Retail sees momentum, right? They see a 50% weekly gain, they see the volume surging, and they jump in out of FOMO, a fear of missing out.
Absolutely.
But they ignore the systemic downside risk that makes that 60x multiple so fragile. For Hims and Hers, the biggest systemic risk is entirely regulatory.
Right.
A massive portion of their recent explosive growth narrative is tied to the weight loss space, specifically compounded GLP-1 medications.
This is the critical piece of the puzzle right here. Hims is currently selling compounded, generic versions of wildly popular weight loss drugs.
Yes.
But they're only legally allowed to do this because of a specific regulatory gray area, which is the FDA's drug shortage list.
Exactly.
Because the major pharmaceutical companies like Eli Lilly and Novo Nordisk, they literally cannot manufacture enough of their branded drugs to meet national demand. So the FDA allows compounding pharmacies to step in and produce generic copies to fill the gap.
And that is the loophole keeping the entire operation running. Hims is essentially profiting off a temporary national supply chain failure.
Wow, when you put it like that.
Right. If those major pharmaceutical companies fix their manufacturing bottlenecks and the FDA removes GLP-1s from the official drug shortage list, that legal loophole vanishes overnight.
Instantly.
Compounding pharmacies would be legally barred from producing those generic copies. Any sudden FDA crackdown on compounded GLP-1s could instantly wipe out that longevity growth narrative.
And if the FDA says stop, the future earnings that Wall Street was expecting completely evaporate, and a 60x PE valuation instantly collapses.
It's the unseen iceberg. It's not just a bad quarter. It's the potential deletion of their highest growth revenue stream.
But to be fair, let's look at the upside recovery scenario, the bull case.
Sure, because the stock didn't bounce 50% on just blind hope.
Exactly. First, you have the potential of a renewed partnership or supply deal with Novo Nordisk itself. If Hims can pivot from selling compounded gray market generics to becoming an official distribution channel for the branded GLP-1 weight loss peptides.
That changes everything.
It does. They lock down a colossal, high-demand revenue vertical that is completely immune to the shortage list loophole.
It would fundamentally de-risk their entire weight loss segment.
Furthermore, they are actively trying to solve that customer acquisition cost problem we discussed earlier.
Right, the leaky bucket.
Yeah. There is a major M&A catalyst on the horizon with the eucalyptus acquisition expected to close in mid-2026.
Which is huge for international growth.
Exactly. This isn't just buying another telehealth brand for the sake of revenue.
Yeah.
Eucalyptus gives them immediate access to international healthcare markets.
And the mechanics of that acquisition are vital. By expanding internationally, Hims can bypass the hyper-competitive U.S. digital ad wars.
Oh, because everyone isn't fighting for the exact same Google keywords overseas.
Precisely. Customer acquisition costs in emerging or less saturated international markets are often significantly lower. They can acquire cheaper customers overseas to offset the margin compression they are experiencing domestically.
That's a really smart play. And finally, let's talk about the FDA. We just laid out how the FDA is the ultimate boogeyman in the bear case.
Right.
But in the bull case, regulation could actually become their biggest advantage.
How so?
Well, there is an FDA advisory committee meeting scheduled for July 2026 to discuss the future of compounding rules. What if they formalize the rules in a way that implements massive, incredibly expensive quality controls?
Oh, wow. That is the ultimate aha moment for the bull thesis, regulation as a moat.
Yes.
If the FDA creates incredibly high barriers to entry for compounding pharmacies, requiring millions of dollars in compliance and testing infrastructure, it will wipe out all the shady, small-scale competitors currently flooding the market.
Exactly. And Hims has the $2.15 billion balance sheet and the massive scale required to actually comply with those strict regulations.
So if the FDA clears out the bottom-tier competitors, Hims goes from fighting for scraps in a crowded gray market to owning a sanctioned, heavily regulated monopoly.
It's a fascinating setup. So bringing all these competing timelines together, you've got daily RSI levels stretched to the absolute limit.
Right.
You've got international acquisitions closing in a few months, and you've got the existential threat or massive catalyst of the FDA looming in July. If you are an investor looking at this stock today at $31, how do you even synthesize all of this?
Well, you have to separate the short-term market mechanics from the long-term fundamental roadmap.
Okay, let's start short term.
In the short term, meaning the next few days and weeks, you must expect severe stomach-churning volatility. We are approaching their Q1 2026 earnings report on May 11th.
And that earnings call is going to be the reckoning.
Oh, absolutely. The company will be forced to answer for that negative Q4 free cash flow and explain whether their gross margins have stabilized.
So the immediate technical test for traders is whether the stock can hold that psychological $30 support level amidst all the pre-earnings turbulence.
Right. But if you are looking past May, if you are holding this for years, the entire thesis rests on hitting their massive 2030 targets.
Which are huge. They have publicly guided for $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by the year 2030.
And if they actually achieve $1.3 billion in bottom-line EBITDA, the current 60x PE ratio will suddenly look like a massive bargain in hindsight.
True.
But getting from $318 million today to $1.3 billion in 4 years requires flawless execution.
Right. It requires the eucalyptus acquisition to successfully lower global acquisition costs.
And crucially, it requires navigating the regulatory minefield without stepping on a tripwire.
Which leaves us with a final provocative thought for you to mull over.
Yeah.
We've dissected the margins, the technical rubber band, the paralyzation of Wall Street analysts, and that 60x valuation trap. But ultimately, the future of this company doesn't depend on a Mac-E crossover.
No, not at all.
Depends on a room full of regulators this summer. When that July 2026 FDA Advisory Committee finally meets and hands down their decision on GLP-1 compounding, will their ruling be the regulatory rocket fuel that sends HIMSS surging back to his $70 highs?
Or will they fix the drug shortage list, close a loophole, and become the regulatory pin that pops the 60x valuation entirely?
It is a binary outcome.
Yeah.
The fundamental business either adapts to the ruling or the growth engine stalls completely.
And that tension is exactly what makes this market so compelling to analyze.
The ultimate battleground stock. Thank you for joining us on this deep dive. As promised, I need to hear from you.
Drop a comment below with your take on the HIMSS debate.
Are you riding this breakout, or are you steering clear of the trap? Don't forget to like the video and subscribe to the YouTube channel so you don't miss our next analysis. We'll see you next time.